Hey everybody, Chris Urso here with URS Capital Partners. So just getting to our Q2 2025 update that we do kind of for the public and our private investors, give you some insight. We've been doing this now. I believe this is our seventh or eighth quarter in a row since we started kind of sharing what's actually going on in our portfolio quarter over quarter, to give everybody some insight. It's been an interesting market now as we're pushing into 2 years, 2.5 years now since interest rates really started to run. It was right around, well, actually 3 years, June of 22, I guess. Rate increases started at the beginning of 22 and then continued to accelerate pretty quickly thereafter to get us to where we are today. Simultaneously, during that time, we had some of the, well, not some, 50-year highs in new supply that started being delivered, call it late 23, and really cresting out in 2025 in most of our markets. So I'm going to talk through some of that, but appreciate you taking the time. For those of you that aren't familiar with us, I am Chris Urso with URS Capital Partners. We've been around since 2009. We started acquiring in 2008. We really started acquiring distressed single-family foreclosures, 1, 2, 3, 4 families, and continued to move into small multi in 2009, buying our first vacant 40-unit apartment building. And fast forward to today, we've gone on to do 30 deals that include 4 ground-up developments and nearly 6,000 apartments. We've sold 23 of those properties. We have about 269 total active investors, and we were fortunate enough, we kind of saw things in 2019. We felt they were getting a little overheated, started selling. COVID came, bought a couple of deals, and then started selling again heavily in 21 and 22. And then we started rebuilding our portfolio back in the beginning of 2024 as we've been seeing pretty meaningful dislocation and some stress in our space for the last 2 years or so. So at this point, we have 10 assets in our portfolio across the Southeast, mainly North Carolina, South Carolina, Tennessee, Georgia, and we also have a great asset up in Portland, Maine. So in the second quarter, I'm going to try to keep this as condensed as possible. We had another acquisition. This was our 8th acquisition since the beginning of 2024, 288-unit Class A multifamily garden property in Somerville, South Carolina, so suburban Charleston. Great asset, bought it from the original developer. Really good group of guys. They just had a meaningful delay in their final CO process, which kind of pushed them out and a lot longer than they anticipated on their timeline. So we stepped in as they had a maturity coming up and closed the property in 30 days from start to finish. And we think it's going to be a great asset. Great basis, $203,000 a unit for effectively brand new product. We were able to get unbelievable agency financing. Day one, we fixed out at 4.77%, 5 years interest only. And we're in the midst of kind of finalizing the lease up. First year, we've kind of planned for it to be a pretty bumpy year as we have some expirations and non-renewals that we're working through. And then we'll look to stabilize within our first 12 to 18 months, and then hold this asset. We think Somerville, Charleston as a whole has a great runway ahead of it. It's kind of on the back end of the supply story and just great fundamentals for the long term. Boeing just announced another $1 billion investment to their facility, expanding that, bringing several hundred new jobs. There's Roper St. Francis Medical, huge investments. Aerospace technology, healthcare, tourism, very resilient market, great quality of life, etc. So to any brokers out there listening, we are definitely looking to expand our footprint in the Charleston MSA. We are focusing very closely on any and all opportunities that may come available in the next 12 to 18 months in the market. So there's my shameless plug to brokers for deal flow. But great asset, excited for it. We also had another big accomplishment in the second quarter. This was one of our COVID purchases. So we're not inherently student housing group, but we developed a property, farmhouse apartments, right next door to this asset, really around the corner. And we owned a bunch of land right behind this. So when this came available during COVID, It was kind of, I want to say, early fall this came to market. We decided to pay attention to it and just to understand what was going on in our immediate submarket, neighboring property, etc. And it was, Q4 2020, thick of COVID. Nobody thought anybody was going back to college. This fund happened to be at its expiration and was forcing kind of a sale of the asset at not a very opportunistic time to be a seller during COVID and through the holidays. So we tracked the deal closely. Ultimately, we started to underwrite it, toured it, started to get a feel for it, reached out to a tremendous management company, Peak Property Management, great job on the student housing side. And we decided to pursue this asset, and it was one of the best buys that we've had during COVID. It's been a great earner for us, very resilient. We've maintained 97 to 99% occupancy since takeover, incremental rent growth of 5 to 7% per year. I think we just closed out the leasing season for 25-26, netting out about 8% increases year over year. We were able to execute. We went in with a very low leverage bank loan on the purchase during COVID. We were able to refinance that and pull out we returned about $6.8 million of equity on the refinance. So we have a new loan at $42.5 million. We were able to bring our rate down about 37 basis points. Reset our interest-only period, enhancing for cash flows further, and set aside a meaningful CapEx reserve bucket. This is a cottage-style student housing, so you have 244 units, 750 beds, but they're all either single-family, 4-bedroom, 4-bath, or 2- and 3-bedroom townhome product. So we're in the process of repainting our first phase of homes. That we'll do over the course of 3 years. We're going to look at some interior renovations during our time, remaining holding period. But great asset. So another big win for the first quarter. So we had a second quarter. We had a purchase and a refinance, and just some underlying market stats for multifamily. As we're seeing supply start to wean, this came out from RealPage a couple of weeks ago. Most of you probably saw this if you're following the market. But I thought it was really interesting. We've been kind of conveying this narrative to our investor base since really through 2023. We were monitoring the market, getting a feel for what direction the market was heading in, and starting to really look at the data. And this is really the thesis playing out as we expected. We're seeing supply wean. We don't think there's a demand problem. So in second quarter, posted some of the biggest demand numbers in the history of tracking. So 800,000 units absorbed relative to only 215,000 new starts. And you can see this is broken out by market here, Atlanta being the number one at nearly, I believe, a 5.6 to 1 ratio of units absorbed to units started. Charlotte's up there, Raleigh, Tampa, Greensboro, etc. You'll see. But on average, it was about 4%. Four units were rented for every new apartment started. So most of the Sunbelt markets are exceeding the national averages at this point. And, this is what we've been watching based on the velocity of leasing. It's been purely an imbalance of supply that's been putting downward pressure on rents in the near term. And we're seeing that start to wean off in some of our markets. It's still a concession-driven market where you have heavy supply. You're still getting flat to negative trade-outs on new leases, but your renewals are incrementally positive. But you're seeing good leasing velocity. So as this supply begins to wean and the demand continues to remain healthy, we're most excited about 2027 through 2030. We've expected and planned for a not an easy operating environment all of 24. I believe all of 25 is going to continue a similar story where we're seeing some bright spots, but you're still earning your occupancy every day. You're fighting for your renewals. You're fighting to fill your vacancies. But come 26, I think that starts to ease a little bit and things get back to more of a normal equilibrium. And then come 27, 28, 29, 30, I think we'll start to see that, demand really take over and supply, continue to diminish back to normal levels. You have to remember, we're experiencing, a rapid run up in rates, nearly 1,000% plus increase in rates. and at the same time a 50-year high in supply. So those two things are putting massive pressure on operations. If you were in floating rate debt, you saw your rates go from 3.3% to north of 7-8%. At the same time, you're seeing rents go down, occupancy go down, concessions, you're seeing expenses rise on taxes and insurance. So kind of creating this, I don't want to call it perfect storm, but it really a perfect storm to put downward pressure on your operations and tremendous amount of stress. So, which creates opportunity, right? This was a big part of our thesis in buying into this because there's a lot of dislocation in the market. There's a lot of operators that are struggling, that are undercapitalized, that did a lot of short-term floating rate debt, that are struggling to get out of that and being forced to either sell or recap their deals or take on some very expensive preferred equity. So ultra bullish. This was really meant to be more on the health of the demand side of things here, but I kind of digressed a bit. So I'm going to go through our Q2 update for our portfolio, which is self-managed by URS Properties. That's our property management division that exclusively runs URS-owned assets. We don't do any third-party work. So a couple things to touch on here was kind of just to see, leads, tours, and net leases here. Mainly focused on occupancy at the close of Q2 versus the close of Q1. This is where we saw our greatest increase, greatest green shoot or highlight across our portfolio. I think some of that has to do with those demand numbers that you saw there, and also the implementation of some, a really fantastic AI-driven, revenue management tool that has helped us kind of shift our thinking a little bit to be more occupancy / NOI revenue, total revenue focus versus hanging on to rents for too long and making blanket decisions or delaying certain decisions where occupancy was suffering in some markets because our rents were too high that we were holding on to, and really being able to see in real time how that translates to occupancy growth. So you could see here, almost across the board, we saw some really positive spotlights on occupancy. Latitude South Portland, 90 to 96, 91 to 97 at Exchange, 90 to 94, 84 to 90, 94. Creekside, this is hard because these three assets run as a portfolio. So I think today they're still right around 98%. So at any given time, there's smaller deals, 62 units. We could have 2 or 3 units that turn over, and that's going to bounce around. Flats at Leland, which was a distressed asset we bought October 1st of last year. We took it down to about 25% occupancy and have been back in lease up. So good, strong movement there. That deal is really, from an occupancy side, we've crushed it. I believe we're 96% leased out today with 84% occupancy as of today, and that's just 2 months ago. We were at 66.7. So we're seeing all that take shape and translate into higher occupancy as a result of healthy demand, a strong spring leasing season, and utilizing our revenue management platform. That's been, again, a great addition overall. So you can see here, this is a number of move-ins, Q2 versus Q1. We'll kind of look at that across the board here. Some meaningful jumps, Crescent Place, 40 new move-ins versus 18. Flats at Leland, 35 versus 26. Latitude South Portland, 54 versus 24. 38 versus 22 at Rock Hill. 32 versus 38 at Views. Farmhouse Apartments, 74 move-ins in Q2. Which is pretty amazing. And then the Ash is our new lease up that we just opened up in May. We had 22 move-ins in our first quarter. Palms at Edgewater, 20 move-ins. That's a new purchase. And you can see here, average increase on those new leases. A lot of these are negative because we really were focused on driving occupancy and taking advantage of the spring leasing season, summer leasing season. However, our renewals are pretty healthy. You can see here, Creekside, Arden, Asheville, and Weaverville, 22, 27, 29% increases, 12, 12, 12. This was part of our business plan, a mark-to-market business plan here. We bought these in November of 2024 from the original developer. They were the lowest rents in the entire Asheville MSA for 1, 2, and 3 bedroom apartments. and we stepped in and took over a very attractive loan assumption with the idea to come in and bring professional management, professional service, and start to bridge the gap between where those rents were and market rents of similar comps. And that thesis is playing out, and we've maintained 95% occupancy through this. You can see Belmont Heights was pretty much flat on new leases, but 5.6% on renewals. Crescent Place, we took rents down because of occupancy. We needed to really drive that. You could see that translated into 40 new move-ins. However, we did get 2.9% increases on renewals. Flats at Leland, these were a lot of the legacy rents that were in place through prior ownership that were a little bit artificially high, again at 25% occupancy. It's kind of hard to gauge where the market was. However, we did make the decision to sacrifice short-term rent to get ahead of occupancy on this, as it's basically a reposition new lease up. Latitude South Portland practically flat, but 1.7% up on renewals. Exchange at Rock Hill, big dip here on the new move-ins, but I want to show you kind of the effect of Rentana, right? Because you look at this and say, okay, wow, rents were down 9.2% on new move-ins. Our renewals were up 1.6%. However, if you go back here and you look at our occupancy, we went from 91% to 97%. So I have this one teed up, and this is inside of Rentana, which is our revenue management platform. And I did this because I think this really exemplifies the best example of, when you're using real time, taking advantage of technology in today's world and actually implementing it to the fullest extent possible, and not overriding the system, but managing the system appropriately. Our team has done a great job. We have a fantastic consultant advisor that's been working with us for about a year and a half. That's been with Greystar and Avalon Bay throughout her career. And we're fortunate enough, she's been working with us for, like I said, a year and a half. And she took the lead on rolling out Rentana throughout our entire portfolio. And their support staff has been fantastic as well in getting our team to buy into this is all data-driven decisions. It's taking the emotion out of holding rents too long or just throwing a concession at something because we're not getting traffic, and not being really intuitive on literally a per floor plan, per unit basis. So I want to show you, this was the beginning of the quarter. Shows you occupancy was at 90.8 and average in-place rents across all units occupied was $16.99. And you see the convergence here. The blue line is our average in-place rents, and the purple line is our occupancy. So when you get to May now, 30 days later, occupancy is starting to grow. We're up 3%, but our average in-place rent was down $20. Now we take it to the close of June. We closed out June at 97.8% with an average in-place rent of $16.66. So you'll see shortly how this translates to NOI, and when we're getting our team to really shift their thinking from don't be short-sighted and just be looking at new lease trade-outs as the indicator on how the property should be performing. Let's really drill down and focus. I know it sounds simplistic, but NOI, 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 and net rental income as a total versus an individual floor plan, or looking at just holding rents too high and sacrificing on occupancy. So when you look at it, 1666 is where we ended the quarter. We started the quarter at 1699. So we're really 3% down, not 3%, $33 down on our rents, which is really only about 2% for the quarter down on our average in-place rents, but our total revenues are up materially because of that occupancy boost. So this is really probably the best example of how this works. And there's a real-time dashboard that we're able to see on a daily basis, across the portfolio, kind of monitor our metrics, see where to focus, where we need to make adjustments. And you can see like Creekside, Asheville. It'll tell you in terms of most recent leases, summary here, all your expiration matrix, your renewals, occupancy, availability forecasts, your comp data, your Rentana insights, which we'll pull here in a second. Kind of gives you a little AI summary. Of course, it's taking a little bit of time to load up, but it scrubs all the comp data on a daily basis. and tells you what specials are being offered, how you're positioned relative to the market, where your comps are. Strong market positioning has achieved 100% occupancy despite competitors offering significant concessions. Market shows diverging trends, with 2-bedroom average pricing increasing 1.3%, while 1-bedroom pricing decreased 7.5% over the last 30 days across competitors. And we're seeing consistent 12 to 25%, renewal and new lease trade outs at our property. So just a good example, I thought, to kind of share a little bit about, how this works and some of the tools that we're implementing. Let's see if it shows. Yeah, so this is going to take you into the whole portfolio. I'm not going to confuse you with that. So we'll go back to this, and you'll see how all this translated to NOI growth for the quarter for us, which was very strong and positive. So I touched on the move-ins and renewals. Bad debt write-off, we're seeing that kind of come in a bit. Crescent Place was meaningfully higher. We were carrying some larger bad debt that's being worked through. It was a handful of residents. That's come down pretty materially. Views at River Bend, we were inside of the first 9 months of takeover here, dealing with a lot of legacy tenants. So Q1 is where we fleshed through a lot of that. 248 units is not a huge number. Crescent Place, again, was probably our biggest, is our biggest. And that number is going to materially keep trending downward as we work our way through that. But you can see some of these other ones were really strong. Haven't seen any real material tenant degradation. And this is probably, this right here is our best indicator that, what we were doing was working both the demand side, the marketing side to drive traffic, working our revenue management platform to its fullest. We saw NOI increase quarter over quarter, 6%, 20%, 30%, 30%, 134%. We went from negative $75,000 for flats at Leland to positive $25,000. Latitude South Portland, strong NOI growth. Exchange at Rock Hill, even with taking those rents down from $16.99 on average to $16.66. We saw NOI grow 9%, views at River Bend, etc. Crescent Place, again, we utilized concessions there. The bad debt's coming down. That's going to be a little bit of a lag. We expect next quarter to be very positive as concessions burn off. So there's a lag. Obviously, we had 40 new move-ins at Crescent Place for the quarter, which was massive. And now that, for those units, if we utilize 1 month or anywhere from four weeks to 1 month of concessions, that's going to continue to burn off, and we're going to capture that revenue as we move forward. NOI, so this is trailing 12 over trailing 12, so some of these assets we don't have it yet because they're relatively newer, but you can see Belmont Heights is up 6%, rolling T12 over prior T12. Crescent Place was down, so this has been a function of taking the rents down. We had a rough Q4, rough Q1. We had a really strong 23 into 24. We had some of the highest rents. We took rents from $988 to over $1,500 in our first 2 years of ownership at Crescent Place. And then the market started realizing all the supply that was coming into it. We had to start pulling rents down. We had some bad debt that we had to clean up there. Again, we expect to shrink that gap on quarter over quarter go forward. Latitude South Portland's up 1%. Exchange at Rock Hill 18%. Farmhouse obviously is now stabilized. Cobalt Row up 23%. Rolling T12 over T12. So I'm more focused right now on the quarterly trends here for NOI quarter over quarter. Sorry, where was that? Right here. This is where we want to see if these trends can hold true. Obviously I don't expect to get 20% increases in NOI, quarter over quarter in perpetuity, but we still have a good ways to go on that business plan. We're only 6 months in. We're now will be a year in November on that. So we expect to see these. The goal would be to land on our stabilized assets year over year in the 3 to 5% NOI growth range. So it'll be interesting to see how it plays out next quarter. Really what we're trying to do is position ourselves really well leading into Q4. We expect to see seasonality, things slow down a good bit as we move into November, December, January. So our strong focus right now is managing our exposure on a go forward as we move into 26. We're still working our way through. We're still trying to manage some of the exposure that we set up a year ago that's expiring before we had the revenue management platform. Our expirations from November, December, January, February, we're trying to move some of those around, offer incentives for people to sign early extensions on their leases, whether it's for 6 months or 9 months, to try to get our expiration management optimal, to be where the majority of our leases are expiring from March through October, and minimize our exposure from November through February. So that's pretty much our big push. You could see here occupancy wise, close of the quarter, and then this is from last week when we put this together. You could see occupancies are still holding fairly strong across the board. Flats at Leland, the most notable, to go from 66.7 as of June 30th to 83.3 in the first week of August. Really fantastic. The team's done a heck of a job, and you can see the 3-pack portfolio, 92, 100, 98, Belmont Heights holding strong, etc. So we're going to continue that theme, focus on driving occupancy, and then we think we're going to be really well positioned. Again, our whole thesis was really predicated on we want to buy good assets in good markets and put a 5 to 10 year hat on everything that we're buying, knowing that the first 12 to 24 months is going to be a little bit of a dogfight, as I mentioned, and we're going to have to really operate through this balance of supply. And I want to show some of that before I get into kind of our strategy, but this all ties in together. We've aged up our portfolio. I think that's another big thing to focus on. Quality seems to be the focus right now, both of asset and location, in terms of being the most liquid in today's environment. Our portfolio, we built our business historically on, buying heavy value add repositioning type assets built in the 60s, 70s, 80s. And we go in, do major renovations, reposition them, get the rents up, and then turn around and sell them. We liquidated pretty much everything in our portfolio that didn't check a box of do we want to own this for the next 10 years prior to the end of 2023. So we took our portfolio down to about 5 or 6 assets. We started new development in 2019. Anything that we're building with the intent to own it for 10 years. These are institutional quality assets in locations that we feel have a very strong runway, both demographically and with population trends that are going on in those particular markets. We think they're going to be great assets to own. So we really aged up our portfolio to primarily outside of Crescent Place, which is our only older vintage asset that we did a major renovation to when we acquired that. Everything else is either late 90s or brand new product. Everything in between late 90s to 2024, 25 product in our portfolio. So, what we're seeing here, I think this displays it really well. So this is Atlanta, a market that we're tracking closely. We think it's a good market to be in. We think it's going to be it was one of the first to get hit the hardest in the form of supply and some bad debt issues, some operational issues in and around Atlanta. Atlanta is obviously a huge market. Look at the amount of submarkets, 44 submarkets make up suburban Atlanta. But you can see here supply really was kind of cresting 24 into 25. And then you're starting to see a material drop off on completions here as you look forward into 26, 27. And this is really a common theme across all the markets that we're focused on. So if you look at Charleston here, we're in the thick of it. And then you look at target completions in 2026 and 27, almost non-existent. If you look at some of the markets here, like Somerville, you have 5 properties being delivered in 2025, which is what we're up against at Palms. We knew that going in. We underwrote it appropriately for the first year, 18 months. And then you start to see that really wean off to only 2 completions in 26. There's really nothing forecasted in 27 in the form of completions. Charlotte was a big one, almost 30,000 units delivered between, call it 24, 25. And now you're seeing that drop happen consistently here in 26. And then as you look out in 27. So these are 50-year highs in supply. You're seeing future completions now forecasting, in your 5-year kind of, the lows of your prior 5 years. More normalization. I think normal deliveries is in the range of, call it 400,000 units a year. We were at almost 1 million units at peak deliveries this year on a national level of apartments. So this is really what we've been buying into. We think the long-term fundamentals continue to be fantastic in our space. We're grateful that we have investors that kind of see the vision. This is Savannah as well. You're seeing peaks in supply being delivered, and then again material drop-offs. We have a fantastic investor base that has been with us now for, many of which have been with us for almost 15 years now. And our thesis is buy good assets, good markets at a good basis, capitalize them appropriately, protect the downside, and the upside is going to take care of itself. I know it sounds a little cliche, but what we're seeing and believing is that fundamental demand and the drivers on demand are continuing to prove out our thesis, right? That this is not a demand issue when it comes to multi. It's purely a supply issue. And then you tack on, the interest rate environment that we're in. It's causing transaction volume to come down materially. We're tracking that. So to give you an idea, on transaction volume just for 2025. So this is just our internal summary of pipeline. So we brought 127 deals in the first 2 quarters of this year that we looked at in some capacity, did full underwrites on 106, offered on 28, and we ultimately bought 1 deal. So I know when people say it, oh yeah, we look at 100 deals, we buy 1. We track all of this. This is our active pipeline dating back to 2023 that we're scrubbing and tracking on a consistent basis here. And now we have that rolling up into kind of a summary for all of our markets, so you can see the deals, so we can track the deals that were brought in on a per market, deals that were underwritten, deals that were offered on, and then we're tracking all the actual sales that happened in each market and the volume of those sales, the vintage of those sales. So we have kind of a true gauge on where the market is pricing different vintages across our markets and how much liquidity there really is. And then we have a roll-up of all the sales that happen that are sorted out by MSA and then ultimate sub-market. The yellow highlights are deals that were in our pipeline. But these are great data points for us to look at, and then we break it down on a per MSA basis. So we can look in, Raleigh, for example, and say, okay, year to date, let's see, there was 1 transaction of 1980s vintage that traded for $150,000 a unit, 157. 1990s vintage, 3 transactions averaged out to 209,000. And then we can come down below here and say, okay, here's the 90s vintage stuff. We can sort by that and then look at the 90s product, kind of look at these deals and say, okay, what kind of trades they were, who bought them, who sold them, what submarkets they were in, and kind of trace back as we're looking at new opportunities in the market. So you can see here not a lot of transaction volume for Raleigh, which is the second largest MSA in North Carolina. For year to date, total of 8 transactions that were recorded through Yardi Matrix. Doesn't mean there wasn't more, and keep in mind we don't include BTR, build to rent, and we don't include anything under 100 units. Charleston MSA, there was 2 transactions recorded, one of which was ours. Original guidance on that deal was $240,000 a unit over a year before we bought it when it came out to market. we hung around the hoop and ultimately acquired for $203,000 a unit. So this is, a lot goes into when we decide to transact on a unit. I'm trying to provide on a unit, on an acquisition. Everybody says they want to take advantage of the dislocation and take advantage of the stress, but when it comes to actually executing on it is another story. We're hearing more and more deals falling apart. These are big name shops that we're only accustomed to having institutional equity partners that are now kind of sitting on their hands waiting and seeing what's going to happen with tariffs, what's going to happen with rates, when is positive rent growth going to come back. So we're seeing a unique opportunity where while the distress might not be rampant on the surface, it doesn't mean that there's not macro pressures. Pricing's down 25% probably on average from the peaks of the market in 21 and 22. Some markets it could be as much as 30, some vintages, some as much as 40%. But we are seeing healthy demand for good quality product that's priced well, and you can look at it and say, hey, you know what? This is a great basis relative to the cost to build this deal today. I can get to a decent yield in the near term, protect my downside, and be really well positioned to take advantage of positive fundamentals that are going to be back in our space over the next 2 to 3 years. So, but the transaction volume shows you that not everyone can do that, right? Equity is very challenging to come by. We're super disciplined on what we want to buy and where we want to buy, and we're looking at as much as we possibly can to get there. So where I was going was, while distress might not be all over the surface, it doesn't mean that all of these factors aren't creating a very unique opportunity where when there's less liquidity, that creates value for those that have liquidity, right? That can transact and provide certainty of closing. You're going to get good relative value versus an environment where there's ample amounts of liquidity and ample buyers for a deal is obviously going to push pricing upward. So we want to continue, going with our plan, which, you can see here, like our strategy is to acquire good assets and, at favorable valuations with the expectation to get to a stabilized cash return of 6 to 10% within the first 24 to 36 months of ownership. At that stage, we're looking at it. We have a free option basically. We're generating tax efficient cash flow. We're in a good asset, good location, and then we'll sell opportunistically, right? As that liquidity recovers, which it will. History has told us that. It's still the most favored asset class across all commercial real estate. It's pretty much multi. Data centers are obviously very hot right now, rightfully so. But, this to me is that window that we've been waiting for to continue to accumulate and buy assets and be patient. Real estate, especially commercial real estate, was never designed to be a super quick transactional business, right? People, all the buyers that were in 21 and 22, buying 10, 12, 15, 20 deals in a given year, are no longer in the market buying deals, right? They've never had to operate through challenging times. They've never had to operate in this type of environment. And they don't have the ability to go out and raise equity because they bought 15 or 20 deals in 12, 24 months at insanely high prices with a lot of floating rate debt, so that they're dealing with challenges across their own portfolio right now. And this is why we want to step in and be a buyer in this market. So you have the private capital syndicators that were overpaying for assets, super aggressive. You have institutional capital that was raising massive funds or has raised massive funds, but they're locked up because they don't have the ability to be as nimble as a private capital group like ours that can lean into a deal because we're on the ground, boots on the ground. We only need to do 1 or 2, 3 deals a year. They need to deploy meaningful capital, but at the same time, nobody wants to make a wrong decision at that level. And they have a lot more layers of red tape to get through to get a transaction done. So I think we want to be in a position to be holding as many good assets as possible when that liquidity opens up and the institutions come back into our space, which they're going to inevitably. So that's our thesis. I rambled a little bit. We continue to remain focused on our markets, North Carolina, South Carolina, Tennessee, Georgia as a whole. And we will continue to poke around the Midwest again and in Portland, Maine, where we have an existing presence. So, we are looking at everything from some distressed deals right now, some deals that we've been tracking from original developers that are going through legacy and estate planning purposes and maybe looking to sell an asset or two in the next 6 to 12 months, to tracking as much as we can within our markets of marketed deals, because believe it or not, that's a great way to really understand where pricing is and be able to capture some good value. Is once the market speaks and runs through the process, we're going to hang around the hoop just like we did on Palms, where we might be told no today, we might be told no 3 months from now, no 6 months from now, but at some point we're going to find a seller that needs to transact, and maybe their buyer that they selected at the much higher price fell apart, much like it did on Palms. They went through 2 buyers before getting to us, and ultimately that was at a almost a 20% discount to where the original guidance was. So if you're interested in learning more about us or have any questions, please feel free to reach out to Rebecca at URS Capital Partners. Appreciate you taking the time to watch this update. It's a little bit all over the place this time, but hope you enjoyed it, and we want to continue doing these for as long as possible. Thank you.